everyone, and welcome back. We are so pleased, I am pleased to have Neil Kane here with us. Neil is the director of the ESTEEM curriculum at Notre Dame University. ESTEEM is the Engineering, Science, and Technology Entrepreneurship Excellence Master's Program. It emphasizes the action of entrepreneurship, not just the study of it. He's also the president of Illinois Partners, providing management consulting and interim executive services. He's been a member of multiple boards. So Neil is going to enlighten us on fundraising at an earlier stage. What happens before you raise venture capital? So Neil, take it away.
Thank you, Tina. Well, welcome everybody. Good morning, good afternoon, whatever it is for whatever part of the world you're in today. So as Tina mentioned, the topic today is fundraising at an earlier stage. This is not going to be a seminar on how to raise capital because there's no way that we can get through that in the 20 to 25 minutes that we have. But my goal today is to help prepare you and give you an understanding of the kinds of issues that you need to be anticipating if your intention is to go raise money. As she noted, I'm a faculty member at the University of Notre Dame. I'm sitting in my office here, but Illinois Partners is a consulting firm through which I do a lot of my other work. And so you'll see that logo on some of the slides. This is who I am. I'm not going to spend time on my background, but what I want you to know is I have a traditional education. I'm an engineer by degree. I got my MBA, but I've started about a dozen businesses. And so even though I work for a university at the moment, it's really because of my experience starting companies, raising money, and doing all of the things that we're going to talk about today. So the two questions that I want to prompt you with, if you're going to raise money, the things that you need to think about, number one, is the business ready? In other words, will investors look at your company and agree that you are ready to be investable? And second, are you ready personally? Raising money is a very grueling, time-consuming, stressful process, as is running a business once somebody gives you the money. So the framework for this is if you're going to go out and raise money and you think that you're going to be contacting investors and doing that sort of thing, you need to treat it as a highly structured sales process. You want to make sure that you know who you're going to contact. You want to do a little bit of research about those people. You want to keep track of the outreach to them, whether you've met with people, emailed them, called them, send them your pitch deck, whatever. Think of it as a sales funnel, and your goal is to ultimately get to the close. That is to get somebody to invest in you. But I'm going to talk now about what precedes that. Okay, so the question that I want you to reflect on, assuming that all of you or most of you are entrepreneurs or you have businesses, if you were talking to me and I were a potential investor and you're pitching me for, whatever, you're looking to raise $50,000 or $100,000, if I gave you all of the money that you're requesting, do you know what you would do with the money? Do you know what you would spend it on? And more importantly, do you know what you would accomplish by spending the money? In other words, if you're looking for money because you need to develop a mobile app, or you need to open a retail store, or you're trying to buy a food truck, whatever it is, you want to be able to explain to your potential investors what is it that you are going to accomplish that's meaningfully going to advance your business with the money that you're trying to raise. Okay, it doesn't do you any good to tell me, well, I'm going to hire 3 people, or I'm going to pay them this, or I've got to hire an accountant. That's more or less irrelevant. I want to know how you're going to begin to create value for your business with the money that you're asking for. And if you can't answer that question, you're not ready. Okay, and I encounter people all the time who have ideas, but they don't know exactly how to put the idea into action. And if all you have is an idea, no matter how good it is, you're not ready to be raising money. The last bullet there gets to another important question, which is if the amount of money that you're trying to raise right now is not going to be the entire amount that you're going to need for the history of your business. In other words, it's common to raise money several times through the evolution of your business. You better have some idea, not perfect clarity, but at least an idea of how much additional money you're going to need after the current round. This little graphic here comes from a friend of mine. If any of you have gone through the lean startup programs or are familiar with the business model canvas, this is sort of a variant of that. But what I want you to focus on here are just the questions. You want to make sure that you have answers to these questions before you talk to investors. What am I selling? What is the product? Who's buying it? Who are my customers? Why are they buying it? In other words, what problem or need am I solving for them? How are they going to know about it? How are they going to procure it? How are they going to pay for it? Who do I need on my team? Do I need salespeople, developers, delivery people, cooks, whatever? Okay. What are my costs? What am I going to spend money on? And how am I going to make money? Nobody expects you, especially if you're a very early stage business, which I assume most of you are, to be able to predict the future or to have precise forecasts for exactly how much money you're going to make. But you need to be able to explain a model, a framework for how you're going to make money if everything goes well. And if you can't do that, then you're probably not quite ready. Okay. Now, the thing that is most important, and if you get to this point, then you're really off to the races. I admit that this is hard to do without any money, okay? But achieving this is really the ultimate goal here. It's something that we call product market fit. That's the degree to which a product satisfies a strong market demand. So if you launch a product into the market, is it something that nobody really cares about? Just a few people buy it because they're curious? Or is it something where you're really solving a need for a known market? And when you have this product market fit, that's when you get to the point to where having more money and more capital allows you really to begin to grow your business very rapidly. If you get a lot of money before you have product market fit, then you're probably wasting money on things like sales and marketing because you haven't yet figured out that you've got a product or service that meets the need of a particular market. This is really, really, really important. Mark Andreessen, some of you may know the name. He's a famous technologist and now venture capitalist. A very famous essay that he wrote, and you can see the link down there. And by the way, I'll give you a link at the end to where you can get these slides. Excuse me. He said product market fit is the only thing that matters, because really what else could it be? And the inverse of that is if you don't have product market fit, there's virtually no way that you can have a successful business in the long run. Admittedly, you may need capital before you get to product market fit, but it's product market fit that really determines your success in the long run. Now, I know this graphic may be a little bit hard to see, but I want to go through it because it will set the stage for the stuff that I'm about to talk about. I don't know if you can see my mouse, but on the far left, it says idea stage, okay? And that's where, and then if you go down below that, it says you start the company. Okay, so the first capital that has to go into a business has to come from the founders. And that could be expressed as the time commitment that you're making, some property like a computer or your house or a garage that you might be contributing. Okay, but one of the key takeaways that I want you to have from this talk is nobody else other than maybe your family is going to give you money unless they see that you're committed first. So if you follow this path from left to right, you can see that co-founders get together. The first money comes from friends and family, people who are contributing to the business, not because they see it as the very best way for them to make money, but rather because they want to support you. Okay, and hopefully they'll make money along the way. Okay, then as you go to the right, you start to move into venture capital, and venture capitalists are in it only for the money. And I don't mean that in a negative way, like they don't care about the people, but they're professionals, they're hired and compensated to make money. They're not investing in you because, you know, they want to see you succeed. Hopefully you will succeed along with them, okay? But key takeaway from this graphic is that venture capital is not what you should aspire to, okay? Very few businesses are ever eligible for venture capital, but there's a lot of ways to be successful first. So we're going to talk initially about equity financing. This is the thing that everybody sort of imagines that they want to do. I'm going to raise money from somebody. They're going to give me cash in return for a slice of my company. If I go back up, you can see how these different rounds are expressed in those pie charts showing, who gets what ownership at what stage, depending upon who's contributed capital. Okay, so equity is this idea of ownership. It's different than debt, which conveys a need to repay a loan. So if you give me $50,000 and buy, say, 5% of my business, I'm taking your money, I'm selling you stock or equity in my company in return for that. And then together, hopefully, the business grows, increases in value, and then eventually you cash out and sell your stock, and that's how you make money, okay? But every time I take money from you and sell you another slice of the pie gets smaller for me, okay? And that's okay if the pie is getting bigger, but if all I'm doing is selling pieces of the pie, then eventually there's going to be nothing left for me. So if you're a founder, you want to be very, very thoughtful about this. There's a bunch of different types of financing. Venture capital is just one of many. Unfortunately, it's the one that everybody obsesses over. It's the thing that they talk about on Shark Tank, but it's really a very small sliver of this. It's much more common to get money from friends and family, to get prepaid by your customers, to talk to angel investors, which we'll get to in a moment, banks, there's ways to get government grants, etc. Okay, so we don't have enough time for me to go into all of these in detail, but I want you to understand venture capital is just one type of financing, and it's very, very rare to raise venture capital. It's like being an athlete in college and then making it to the pros. Okay, it happens, but it's very uncommon. The other important idea that I want to leave you with here is when you sell a piece of the pie, like I showed you a minute ago, that's called dilution. I'm diluting my ownership. I'm trading my ownership, if I'm the entrepreneur, for money. But there are other forms of non-dilutive financing, meaning I bring money into my business to help me grow, but I'm not giving up ownership in return. And that's getting money from customers, it's borrowing money from banks, it's doing certain types of crowdfunding, government grants, and the like. The problem with the bit on the right, it sounds great the way I posed it, except that if you're a young entrepreneur and you don't have a history of being successful, or you don't have a lot of personal assets, no bank is going to loan you money, okay? So loans and banks and some of the other things that I'm talking about here are great eventually, but they may not be the way that you're able to raise money when you get started. So remember back to the graphic I showed you, the first money comes from you or your friends and family, people who know you. And then long before you raise venture capital, you might want to talk to angel investors. Angels are high net worth, i.e. rich individuals who are investing their own money. So you may know, a lawyer or a doctor or an executive, somebody who you're kind of like, hey, I know this person can afford, $50,000 and I want them to invest in my business. They're making decisions with their own money and they can make decisions very quickly as a result. Venture capitalists are professionals who are investing other people's money, not their own. They're paid by other people paid by university endowments, public pensions, large corporations, some banks and insurance companies give money to venture capital funds. The venture capitalists invest the money and hopefully make a lot of money for everybody, and then they get a portion of it as individuals. But VC is late stage money. It's only for high growth opportunities. It typically doesn't happen until after you begin to find that product market fit and start growing, okay? And it's very expensive money, meaning you give up a lot in terms of the slice of the pie in return for that. The one thing that you must understand, though, about raising money from investors is investors don't fund businesses, they fund people. Okay, so they'll be looking at you, not just for the business presentation and what are you doing and how are you going to make money, i.e. answers to the questions that I showed you on the graphic a couple slides back, but they're going to want to know about you. Are you accountable? Do you have integrity? Do you have a track record? Can they believe in you? Are you going to work your tail off to try to make the business successful, or are you going to give up as soon as things get difficult? Okay, so don't forget that a big part of raising money is selling yourself, not just selling the business or the business opportunity. If you're lucky enough to get to the point where you get an investor who says, hey, I'm really interested now, I want to invest in you, they're probably going to begin a process called due diligence. Venture capitalists do an extensive amount. An angel investor or your uncle or grandparents may do a much lighter amount, but due diligence is basically a process of making sure that if somebody gives you money in return for stock in your business, that you actually have a business, that it's legally incorporated, that you're paying your taxes, okay? So due diligence is kind of a legal term, which is basically all about fact finding and making sure that you're not like basically defrauding somebody, okay? If you go out to the internet and Google or search on the term due diligence checklists, you'll find a lot of these. But basically, it's just this long laundry list saying, you know, show us, as you can see here, you know, a list of all of your investors, show us all of your contracts, all of your agreements, you know, show us evidence that you paid your taxes and that you have a corporation and that your, you know, chief technical officer has a non-compete agreement and just all of this stuff. And if you're doing your business correctly, while this may be time consuming, it shouldn't be onerous. But if you're not, then you're gonna have some problems. The deal, okay, when somebody says, hey, I'm actually going to give you money in return for stock, usually there's one of two kinds of agreements, contracts, that actually makes that happen. Traditionally, it would be through something like what you see on the slide there called a preferred stock purchase agreement. It just says the company is selling this many shares of stock in return for, you know, this much money, and then there's about 40 pages of legal stuff. Much more commonly today, and I wish we had time to go through this, but you may also want to search for this online, is something called a SAFE agreement, S-A-F-E. It's an acronym, stands for Simple Agreement for Future Equity. And it's a much simpler version of raising money, raising equity from investors that dramatically simplifies everything that I'm talking about. The diligence is simpler, the agreements are simpler, and it's really, really common these days that if you're raising a modest amount of money, let's say less than $1 million to get your business off the ground, from angels or people that you know, chances are very likely that you'll be using a SAFE agreement initially. Eventually, you get into more complex areas where these other agreements come into play. Now, the second part of my talk here is about you. Are you ready personally? Okay, you really need to stop and look in the mirror and answer some tough questions before you go too much farther. Raising money is extremely grueling and stressful, but building a business is even harder. And I know all of you are probably sitting there saying, I've got this idea, I've got this burning passion, I want to build my business. Why? Somebody's just got to give me money and I'm ready to go. And I can tell you from firsthand experience that the minute somebody says, okay, here's the money, now go build the business, trust me, that is the moment when the stress really starts, because suddenly you're accountable to other people. Your ego, your reputation, your skill, your capability, it's all on the line at that point. Fear of failure, no matter how cocky or confident you are, you'll just be awash in all sorts of emotions, especially if you're doing this for the first time. It's really tough. You'll want to make sure that you have a good coach or a good advisor or a spouse or a close friend or somebody who can just be a sounding board for you. And in these last few slides, I just encourage you to get in touch with your motivation, all right? Is it to make a lot of money? Is it to be famous? Is it to help people? A lot of people start businesses because they see a problem in the world and they want to create a solution to the problem. Maybe you're trying to do something that's, in sustainability or helping to solve global hunger or global warming, something like that. So your motive could be social, or it could be derived from wanting to help people. But you really got to get centered around understanding why you're in this, because I guarantee you, you will be extremely challenged at times, questioning, why am I doing this? Should I continue to do it? I didn't know it would be so difficult. And then finally, there's a lot of different reasons to become an entrepreneur. Okay, a lot of people talk about you want to be your own boss, you want to be self-reliant, you want to pursue your dream, you want to make a lot of money. Okay, you want to put a dent in the universe, as Steve Jobs famously said. Okay, you don't want to take direction from people. All of that is fine, although I'll tell you that if you go out and raise money from other people, you will have bosses. You will be accountable to other people. Okay, so this idea that you can kind of do as you please or be completely self-reliant is a myth, unless you're 100% using your own money. The minute you take money from somebody else, you're incurring a lot of extra obligation and responsibility. So please get clarity about what you're doing and what you want this journey to look like. Go talk to people who've been there and done that, who can advise you throughout the process. I think we've got a couple minutes left for questions. Here's my contact information. If you look at the link on the bottom, illinoispartners.com, and if you don't remember the last part, it's very easy to find. If you just remember illinoispartners.com, you can hit that link and download a copy of these slides. So with that, I'll turn it back over to Tina, if I'm able to, and we'll take questions or
All right.
however we want to wrap this up.
Thank you, Neil. That was amazing. I think a lot of, at least fresh entrepreneurs, they don't get that information, right? So this is a perspective behind the scenes to really help them move forward. That's amazing. I did want to ask, I had one question as you were talking, when you said investors don't fund businesses, they fund people. I think that's probably investors across the board, right? Not just VCs, but anybody who's going to be putting their money into something. What are the, you listed a few of them, but can you talk a little bit more about some of those characteristics and traits that are really important in that?
I would say the biggest one is being accountable. And we've all experienced this in different spheres of our life. But if somebody contacts you or they're pitching you, is their follow-up good? Do they do what they say? Do they get back in touch with you? If they've promised you information, are they responsive? Are they defensive when you question their business, or are they professionally handling your concerns? Do they have a track record? What's going to happen when investors, as they might do, contact your personal references or talk to employers or people that you've done business with? Are people going to say about you, hey, she's great to work with, I would do it again? Or are they going to say, no, she's defensive, impossible, bad people person, nobody liked her, she alienated her team? I mean, what are people going to uncover? It's no different than if you were applying for a job. In fact, the rigor might even be more intense. And so this kind of segues back to my last slide, which is this belief that you're going to start a business and raise money from other people because you want to be in control of your destiny and not answer to other people. That's just a myth. Yeah.
No, that's wonderful. Thank you so much. And as we close out, can you just tell us again, where can folks find you?
Sure. IllinoisPartners.com. Really easy. IllinoisPartners.com. I have a lot of different affiliations, but if you can just get to that website, you'll be able to message me if you need to. You'll be able to download the slides. You can find me on LinkedIn if you make sure that it's really me. I'm happy to connect with anybody on LinkedIn. I would just add, especially if you're a student, please, if you send me a LinkedIn invitation, tell me who you are and why you want to connect with me and how you heard from me. Tina, you've probably encountered this, but I get all these fraudulent and fake LinkedIn connections these days. So I don't accept them anymore unless I know the person who's trying to connect with me. But
Absolutely.
Subject only to my bandwidth. I'm, happy to be helpful, and I've got tons of information, other resources and slide decks and templates and all sorts of things out on my website. So I'm happy to hear from anybody, and we'll try to be as helpful as I can be.
That's wonderful. Thank you, Neil, so much for this time and sharing your expertise. It's been amazing.
My pleasure. Thank you.